Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we are diving into CLARIVATE's 2025 proxy statement. Proxy statements, think of them as the shareholders' peek behind the curtain, a chance to vote on company decisions and maybe, just maybe, influence where things are headed. But if you think that voting will solve CLARIVATE's financial troubles, you might as well ask nicely for world peace. You might have a slightly better chance. First things first, this is a standard filing with the SEC, meaning CLARIVATE isn't paying extra to keep anything secret, which is always a good start. One of the main items on the agenda is to get shareholder approval on how much the top executives get paid. This is like asking the audience if they think the actors deserve their salaries after watching a movie. It's advisory, so the company doesn't have to listen, but it's a good temperature check. Shareholders will vote on whether to allow the company to buy back its own shares. Think of it like this. The company thinks its stock is a bargain, so it wants to buy some up. It can signal confidence, but also prop up the stock price short term. If you owned CLARIVATE shares on March 10, 2025, you get a say at the meeting. It's like a club membership where only those who joined by a certain date get to vote. You can vote online by email, mail, or in person. If you were registered, you would have gotten instructions. If not, you should ask your broker on how to vote. Each of the votes needs more than half of the votes to be approved, except for Proposal 5 that needs a 2/3 majority to pass. Spoiler alert, the board is recommending that you vote for all the proposals, so they clearly want things to go their way. Time to re-elect the board. This year's nominees include people from various backgrounds like investment firms, consulting, and academia. It's like picking your favorite players for a sports team, hoping they'll lead the company to victory. The board selected Suzanne Hayward, an important name on the financial landscape, because of her experience in finances and strategic matters. Non-employee directors get paid for their service and can choose to get their payment in cash or shares. For example, the audit committee chair gets $30,000 annually. For example, Andrew Snyder, the board chair, earned $25,000 in cash and $165,000 in stock. Usama Cortez did not get paid anything in cash, presumably since he is affiliated with Leonard Green and Partners. These are the guys who make the day-to-day calls for CLARIVATE. The report lists Matti Shem Tov as Chief Executive Officer, Jonathan Collins as Executive Vice President and Chief Financial Officer, and others. CLARIVATE uses a mix of fixed and at-risk performance-based compensations. The business objectives that are used are annual incentive plans and long-term incentive programs. They use benchmarking and market data to structure executive pay. But it is not all numbers. Experience and responsibilities also matter. There are some good corporate practices in place at CLARIVATE. They make sure that their executives have skin in the game by adopting share ownership guidelines. But there are some things they don't do, like allow employees to engage in hedging transactions, which are transactions that protect against investment losses. Alright, let's talk money. Matti Shem Tov, the CEO, has a base salary of $900,000. Other big names like Jonathan Collins and Bar Weinstein make $600,000. But remember, most of their pay is tied to performance, so if the company does well, they do really well, but if it doesn't. AIP, or annual incentive plan, is decided via 90% based on adjusted EBITDA and 10% on voice of customer. This is basically how happy the customer is. For example, a customer can say great, good, or bad. The voice of customer performance was 90% of the target and 62% for pre-bonus adjusted EBITDA. So a target AIP payment for the president of IP, a Mr. Sampson, results in final AIP payment of $390,000. A big part of executive pay comes from company stock or equity. For most executives, it's a 50-50 mix between time-based awards that vest with time and performance-based, which vest based on company goals. For 2024, the stated goals were adjusted diluted EPS and adjusted EBITDA with a TSR modifier to account for the reality that markets can just go up or down. In terms of awards to their executives in 2024, Jonathan Collins got 1,777,053 in restricted stock units and 17,733 in performance stock units. That's on top of separate one-time bonus grants. There's also an insider trading policy in place to keep the game fair, to prevent those with inside knowledge from using it, and no hedging policy to prevent their executive from unfairly benefiting. In the most recent few years, net income has decreased with negative numbers in 2022, 2023, and 2024. During these years, the total shareholder return also decreased from $176 down to only $30. While the market has gone up, they have underperformed, but you have to keep paying those base salaries and other cash benefits. Shareholders are also being asked to approve a plan to buy back company shares. It's a way to return value to shareholders and potentially boost the stock price. If approved, CLARIVATE could buy back up to 100 million shares between 2025 and 2030 for between $1 and $35 a share. Now, let's talk about potential conflicts of interest. There are related person transactions, which basically means the company is doing business with people connected to its executives or board members. For example, CLARIVATE leases space from Cambridge Information Group, where board chair Andrew Snyder is the CEO. In 2024, this cost CLARIVATE around $2.1 million in interest. Also worth mentioning is that the company is also paying for the tax advisor fees. Another big thing, Exor NV, which owns nearly 10% of CLARIVATE, gets to nominate a board member, which currently is Suzanne Hayward. Now for my personal take. I'm a bit concerned about CLARIVATE's recent performance. While they are trying to stay competitive and keep executives motivated, the numbers tell a more complete story. They need to show revenue growth and boost shareholder return. It is clear that shareholders are not happy with the performance. The related party transactions, while not necessarily scandalous, raise questions about where the priorities lie. Ultimately, CLARIVATE has some fundamental issues to fix if it wants to become a market leader. Thanks for watching. If you found this breakdown helpful, please like, comment and subscribe for more corporate deep dives. See you in the next one.